Welcome to the final part of my series about buying a home. If you missed the start of the series, you can find it linked here. Now that you've found the right realtor and the right property, it's time to make an offer. In order to make an offer, you'll need to drop a purchase contract to send to the seller. Much of this contract is pretty standard language and is used by realtors over and over, but there are 5 primary things you'll need to decide on. First is the purchase price you plan to offer. Depending on how hot the market is, this could be above or below the asking price. Your realtor should be able to give you feedback about the chances of your offer being accepted given what they've seen on similar properties in the area. Second, you need to specify how much time the seller has to accept your offer. It's usually a few days at most. You don't want a seller sitting on your offer and preventing you from making other offers for too long. Third, the seller will expect to see a proof of funds, which is where you'll use your pre-approval letter discussed in the first video of this series. Fourth is an earnest money deposit amount. This is usually 1 to 3% of the total purchase price. If the seller accepts your offer and you enter into a purchase agreement, then you'll have to write a check for this amount. This money will be held by a third-party escrow company. If you follow the terms of the purchase agreement, then it will be applied to the purchase of the house, or returned to you if you walk away for a contractually permitted reason. If you break the terms of the agreement, then this money will be forfeit to the seller. This is a way to protect sellers from dishonest buyers wasting their time. Since a seller takes their house off the market once a purchase agreement is in place, they're taking some risk in lost opportunity by accepting your offer. It also looks bad to future buyers if they see a house go under contract and then fail to close, as this implies something may have been discovered during inspections. Without earnest money in place, a buyer could enter a purchase agreement and waste a lot of the seller's time with no risk to themselves. Earnest money ensures that buyers are sharing in the risk and entering a purchase agreement in good faith. The fifth item is any contingencies you want to include in the contract. Contingencies give you as the buyer specific reasons to back out of the purchase contract without losing your earnest money. These could be anything you want, but 4 of the most common contingencies are financing. You as the buyer have a period of time to obtain financing, and if you fail to get a loan, then you can back out of the deal. Appraisal. The buyer can back out of the deal if the home appraisal comes in lower than the purchase price. This contingency is often rolled in as part of the financing contingency. Inspections. The buyer can back out of the deal if they find any issues whatsoever when they do inspections. If you have this contingency, be sure you also specify a time window for completing the inspections, usually 1 to 2 weeks. Inspections are the most common reason for backing out of a purchase contract, since every inspection finds something, even if it's small. And fourth, sale of a prior home. If the buyer can't sell their existing home before a certain deadline, they can back out of the deal. This is especially important when you're looking for a new home before your existing home has officially sold. There are no limits to what you can put into a contingency. It's just any clause that you and the seller agree to make part of the contract. Once you've submitted your offer, it's very common to receive a counteroffer from the seller asking for a higher purchase price or changing other elements of the contract. Sometimes this negotiation will go back and forth several times, so be prepared to respond to their counterproposals. If an agreement is reached, then both parties will sign the document and start to work towards the defined deadlines. The first deadline defined in the contract is your earnest money check, which usually needs to be provided within a day or 2 of signature. The second deadline is likely the time period in which you must complete your inspections of the property. How many inspections you do will be dependent on your lender requirements, your budget, and the age and condition of the property. It's possible to buy a property without any inspections, but generally I don't recommend it. At the very least, I recommend getting inspections of the roof, heating, electrical, and plumbing systems. Depending on the common issues in the area, there may be other critical inspection items like mold, termites, foundation stability, or radon gas. Ask your realtor what's common practice in the area you're buying. It'll likely cost a few $100s per inspection for a specialist. Or you can choose a general inspector who's less specialized but will give everything an overall look. Just be aware that inspectors are not liable for finding all of the issues. Their only responsibility is to perform their inspections up to industry standards. This means that you could still be on the hook for expensive repairs that the inspector missed. Almost every inspection will reveal issues, but most of the issues tend to be small code violations that usually have little to no cost to fix. If the inspections did find major issues, then this is an opportunity to ask the seller to fix them. Depending on how hot the market is, they may say no. In some cases, the lender will not approve your loan unless every issue is resolved, so you have no choice if you want to buy the property. FHA loans, for example, require an FHA-approved inspector and are very strict about all issues being resolved. If the seller isn't willing to fix the issues or lower the purchase price, then you'll need to decide if you want to walk away or continue with the purchase covering these costs yourself. It can be emotionally difficult to walk away once you've invested this much time and money into evaluating a property, but unfortunately it happens all the time. Once you make it past the inspections hurdle, the next big deadline will be final loan approval. One thing you'll need for loan approval is proof of homeowner's insurance. You can contact any homeowner's insurance company and let them know you're in the process of purchasing a home and want to set up a homeowner's insurance policy that will start on the day you close. They'll ask you various questions about the property and the type of coverage you want in order to provide you a quote. Now that you have a specific property under contract, you'll also need to share the address with the lender you plan to use. If you completed a pre-approval, then the underwriter at the lending bank will mostly be focused on getting an appraisal and inspection of the property you want to buy. If you skipped pre-approval, then now's the time you'll need to submit all your personal financial documentation to the bank to be evaluated. The two biggest risks to getting final loan approval are 1, if your financial situation has changed since your pre-approval, like you lost your job or your credit score dropped significantly, or 2, if the appraisal comes back at a lower value than the purchase price of the home. Once your loan is fully approved, the last step is closing on the property. For closing, you'll go to a title company, though many are being done remotely since the COVID era. Here you'll review and sign all the final documents. It's typical to do a final walkthrough of the property the morning of closing to ensure the seller is fully moved out and the condition of the property matches the contract. Legally, they'll need to provide you all of the closing paperwork a few days before closing so you can verify everything is correct. That paperwork will also include the exact amount that you need to write a check for to complete closing. This final amount will take your down payment amount, subtract the earnest money that you've already paid, add property taxes that the seller has already paid, and add in closing costs, which are usually an additional 1 to 2% of the total home price. You'll bring that check along with your ID to the closing to finalize the purchase of the property. You should walk away from closing with all the keys, garage door openers, and closing paperwork to prove you're the new owner of the property. Congratulations, you've finished the home buying process. If you stuck through to the end of this video series, then you should have a pretty solid understanding of what to expect when buying a home. Let me know in the comments below if you have any home buying questions. See you next time.